Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today, as right in the middle of August. We got a lot of inflation news here this week, and we're certainly going to spend the majority of this program talking about it and the impact on the market. So if you're new to the program, welcome. Thank you. Please like, share, and subscribe to Shepherd Wealth Management. If you are a longtime listener and viewer, welcome back. And I think you're going to get a lot out of today's particular program. We're very happy to be getting ready for school this week as well, and getting stuck in traffic behind school buses in the morning. Super fun. Got to get used to that again. Ez, not sure how things are down there in Nashville at the moment, but anything that you're excited about here coming up at the latter couple weeks of summer?
No, I'm always sad to see summer go. Even though I don't have to go to school anymore, either as a student or a professor. I still get really kind of nostalgic this time period. I miss school like I miss the Weather Channel. You know, remember the great music and just like having that thing on, falling asleep at night. I miss the Weather
Yeah,
Channel. Miss school. I miss all
I
the
don't know if I
gear for
miss
school
school.
too, like all the cool '90s trapper keepers and like gripper pencils and stuff. Like that
Yeah,
stuff used to get me so excited to go learn.
yeah. Like my youngest daughter's, or not my youngest is 7 months old, so she's not in school yet. But my middle daughter, who's about to be seven, it's going into first grade time. My oldest is going into her junior year of high school, which is super crazy. Very excited for her. Big year. She's doing great. Awesome student. But my middle one, she loves what you just said, like all the back to school shopping, the stuff, the backpacks
Oh
and
yeah.
lunch boxes and all that. And I have some, thoughts about that. I think it's super cool. I enjoyed all that stuff when I was a kid as well. Back to school shopping, always got, lucky enough to have parents that, would buy clothes for my sister and I, nothing crazy, but, a few new outfits to go back to school in. Super excited about that. So, yeah, all that's going around the country right now. So I'm excited for all the stay at home moms like my wife, going to have a lot more free time to do your thing as kids are in school. So congrats about that. I know a lot of moms are excited about that, and certainly happy for uh, this part of the year coming up because football is back, baby, and
Ooh,
that's what
yeah.
back to school means to me. And I'm super excited about watching the Cincinnati Bengals kick some butt this year.
Yeah, we're hoping they're going to have a really great season. My dad was just telling me about the preseason game he watched. I guess the first one was this past weekend where said Burrow and Chase were just kind of on fire. So
Yeah, man, best
as an
tandem in the league.
LSU alum, that's exciting to hear.
For sure, yeah. I mean, we could go on a tangent with that one, but yeah, just
Oh yeah,
thinking about the LSU squad that they had when they won it all, probably one of the best lineups of all time. But that might be a debate for another podcast.
different podcast. Yeah, that's our ESPN affiliate that we do right after this show.
Yeah, exactly. But yeah, welcome back to the show. Please like, share, subscribe to us. The reason why we do this, why we're here, first of all, it's a lot of fun, and we're going to get to some really important news here today. But the main reason why we do this is we try to wrap around historical data as to what's going on here today, and that does a couple things for investors. It kind of puts some perspective in the right place regarding risk and reward by selling or holding, given what the news is right now. And if you understand how other human beings have behaved under very similar circumstances, it helps to understand the individual understand what the true risk and reward is for every decision that they make, so they can go in there with their eyes wide open and not be emotional about any of those decisions. And that's what Warren Buffett famously said for decades. The number one reason that individual investors do not achieve the results that they're looking for consistently over time is they have no control of their temperament. In other words, emotions. So, how we solve that problem here at Shepherd Wealth Management for our customers is delivering content just like this, but also providing historical context, saying, yeah, we've had inflation go up and down over the course of history, but here's how other human beings reacted under similar circumstances. And here's what the market looked like 6, 9, 12 months later. And you can even break it down from there and saying, okay, if the market is likely to be up over these circumstances, what's the probability of success? Well, okay, if we expect the market to be up 90% of the time under these circumstances over the next 12 months, what was the actual return of the S&P? Now that we understand that, well, what sectors did the best within the S&P? There's 11 sectors that make up our stock market here in the United States. And now you can start to build an asset allocation based on your personal situation and risk tolerance, understanding what the risk and reward is for investing in those sectors, for investing in the market over that length of time. It completely removes emotion from the equation, and that will provide you a consistent type of successful investing process over time. And that's what's worked so well here for our customers at Shepherd Wealth Management. Thankfully, after 4.5 years of being in business, we're managing over $160 million in assets for our customers, which is amazing. And those customers are very satisfied and referring us to their friends, family members, and coworkers across the country. We're working with folks in 19 states right now. We can work with any United States citizen in this country. Um, and on average, they're all significantly outperforming the S&P 500. So a lot of growth, and it's because of the process that we take. It has nothing to do with me being able to read a balance sheet, an income statement, or listen to an earnings call any better than the next guy or gal in this industry. That's a very hard way to separate yourself from others in this industry, just trying to simply be smarter or better at reading a balance sheet and income statement. That would be very difficult to do. But what you can get an advantage on is just understanding that the market moves up and down based on how other human beings react. That is the one thing when I look at the stock market that is consistent and reliable. Now, past performance is no guarantee of future results, and investing involves risk, including risk of loss. There aren't any recommendations here, folks, on this particular show because I only make recommendations for our customers who we meet with regularly, and I understand their situation very, very well. But we will get into how we plan to handle some of this news that we're going to be talking about here today and what that might mean for our customers in the future. So, welcome back to the show and buckle up because we're about to dive into some data here, folks. So, this week is all about inflation in the news. And I want to take a step back here to, I believe it was Tuesday of this week. Yeah, Tuesday, August 12th. We got headline inflation. So, this is your CPI figure here. This is what consumer price index looks like for the month of July, being reported, like I said, this Tuesday. So CPI was expected to rise month over month, 0.2 in July. That's exactly what happened. The prior month reading was zero point 0.3, so a slight tick down, which is a good thing, consumer price index wise. And then same thing year over year. Market was looking for 2.8% year over year consumer price index. It came in a little lower than that this Tuesday, 2.7. And that's actually where it was the prior month as well. And again, the core CPI, which is something the Fed cares a little bit more about, last month was zero point 0.2. Economists were expecting zero point 0.3 for July, and that's exactly what happened for core CPI month over month. And then same thing, core CPI year over year came in exactly as expected, 3.1 is what economists were looking for. So Tuesday, Wednesday, really good market days. Today, at 8:30 in the morning, we got the wholesale inflation number, otherwise known as PPI. And we're going to spend a little bit of time talking about this in some detail here in a second, but let me get you the numbers. The prior month, it was flat, completely flat. And economists were looking for zero point 0.2 on the producer price index, otherwise known as wholesale inflation. It exploded to the upside. Zero point 0.9 is the number that we got here for producer price index headline. The core, which again is a little bit more important to the Federal Reserve, producer price index was zero again last month. Economists were looking for zero point 0.3. It doubled that at zero point 0.6 for the month of July. And then if we look at it year over year, core PPI is at 2.8, and the last reading was at 2.5. And lastly, we got initial jobless claims this morning as well, right after that producer price index came out. Economists were expecting initial jobless claims to be 229,000. It was a little lower than that, 224,000. So it looks to me like the job market is still very tight. Um, However, we had some poor jobs data, not that long ago, just a couple of weeks ago, and this data is looking really good. So I would say this before we dive into the rest of the data. I think the Fed has mentioned this many, many times. You can't look at one print, inflation print in a silo. It has to be taken in an aggregate. So 7 months of excellent inflation news with today's news. We'll see what it looks like again next month because we do get one more month of data before our next Fed meeting, which will be right in the middle of September. I think the Fed is definitely looking at this data very closely and coming through it. But I do want to share most of today's program. I mean, I've definitely whacked Barron's pretty hard due to a lot of what I believe unbiased or a lot of biased reporting, given some of the news that we're actually still talking about regarding inflation and jobs. So check out the last couple, Shepherd Wealth Management podcasts on YouTube. I think we have maybe over 1,000 videos up there, if I'm not mistaken. As um,
We do. And recently, Barron's has made themselves a very easy target. So thank you for the content,
yeah,
Barron's.
yeah, I appreciate that. You can't really run out of content, specifically when you're in this business and you're able to read a lot of different viewpoints on the economy. So there will never be a lack of content here at the Shepherd Wealth Management Podcast. That's for sure. But yeah, last couple uh, times that we've been here doing a podcast, Barron's has definitely been a very easy target. But today, I'm giving them a lot of credit. So let's do that because the person that wrote this morning, Megan, definitely does deserve some credit here for what I believe to be very fair and balanced sort of reporting on the information because the market you would expect on that hot inflation number, at least on the wholesale side, would just completely sell off and interest rates across the bond curve would rise dramatically. We're just not seeing any of that here today. So I want to talk about why that is. But before we do, let's share some of this Barron's article here. And the headline of this is wholesale inflation shows fastest monthly gain since 2022, which is in fact correct. So like I mentioned, the producer price index rose 0.9 in July, lifting annual rate to 3.3. The Bureau of Labor Statistics reported Thursday morning. It's the fastest monthly increase since May of 2022. And 2022 was a really tough year for stocks. You had the Fed having to increase interest rates at the fastest clip in human history, or at least in 40 years. And that was a very difficult, year for stocks, which is why I mentioned you would have thought, right, if you weren't able to turn on the news at all this morning and you just got that information, you'd have thought we would have seen just this major sell off, very similar to what we had going on in 2022. And that's not happening. And I have some thoughts about why that is here in just a little bit. Um, July's annual growth in wholesale prices was the largest 12-month increase. This article goes on to say since February, when the gain was 3.4%. Uh, Thursday's stronger than expected today's PPI data suggests that tariffs are not helping, but they're not the only issue at play for wholesale price growth. Like with consumer price index published Tuesday, as I mentioned, service cost advanced more than the goods on the month. Final demand for goods rose 0.7 month over month in July, up from 0.3 pace in June. And demand for services shot up 1.1 last month, reversing course after falling by 0.1 month over month. So again, 1 month's piece of data, and I do give the Fed chairman and all the Fed heads credit for this. It's hard to say now we have a major problem here in our hands. So let's get back into Barron's article here. Within services, it was 2% increase in trade services that pushed up the entire sub-index. Quote, this is a measure of corporate profits and suggests possibly that some companies are using the excess of tariffs to boost prices for their own gain. In fact, much of July's unexpected robust PPI gains were driven by a 2% expansion of retailers and wholesaler margins, as well as a 5.8% jump in portfolio management. The jump in margins is particularly perplexing given that there's evidence companies are absorbing the lion's share of tariff impacts rather than immediately passing on the cost to consumers. The surge in portfolio management, however, is likely due to the second quarter stock market rebound. So stocks went up. That's a sector of the market and is measured in all of this data. As the market goes up, well, certainly the profits go up for shareholders, and that is, in fact, a margin impact in a good way. Obviously, people want to make money if they're going to put it at risk in something like the stock market. Oh, getting back to the article. Still, there were signs that tariffs are having an impact, with the index for core goods rising by a larger 0.4% month over month. That's the highest gain in over a year, and a pickup from 0.2 pace in June. Food prices surged 1.4% last month. Much of this is likely to pass through, the article says, at least to some extent, to consumer prices over the next month or two. The prices of computers, home electronics, household furniture, and appliances, items that are likely more vulnerable to tariff effects, rose sharply on the month. Um, Here's the main point here. Finished good core service prices, which exclude food and energy, rose 0.3 in July for the fourth consecutive month over the last 6 months. Finished good prices have risen 3.5% at an annualized rate, and this suggests that firms are passing through tariffs on import cost or they're raising prices in the face of diminished price competition. The fact that top line figures in July PPI data were stronger than expected and Tuesday's CPI report was relatively soft still indicate that there's more cost in the pipeline that need to work their way through, writes an economist in this article. And businesses may soon start to reverse course and start passing these costs to consumers. Many economists say that taken together, the latest PPI and consumer price index data released Tuesday signaled that personal consumption expenditure price index, otherwise CPI, would round to zero point 0.2 monthly gains in July, and that would likely help keep the annual rate unchanged at 2.6%, wrote Bank of America economists. Core PCE, which also excludes food and energy, is expected to rise zero point 0.3 in July, likely boosted by stronger portfolio management fees. All said, this should lift the annual rate to 2.9 in July, up from the June's previous 2.8. So here's what I'm getting from this article is that a lot of economists have been calling for this all year long. Some sort of increase in wholesale prices that would be passed along to consumers eventually. Now, again, one piece of data, we'll find out more as we go through the remainder of this year, starting next month. So I still think the answer to a lot of economists' question of is this going to spill over into other sectors of the economy, or will there be other offsets due to lower taxes, lower regulations, etc.? Will those offsets not mean so much for consumers and inflation? I say the jury's still out. 7 straight months of really good inflation data. This particular, and again, Tuesday's data regarding consumer price index was outstanding. Um, but this wholesale inflation number definitely is going to give, depending on which side of the aisle you're on here regarding tariffs, something to talk about for the next several weeks. And now that we're basically wrapping up earnings season, this is probably going to be the only thing that people are going to want to talk about. And the Fed has no official meeting next week, but they are meeting in Jackson Hole, Wyoming, at an annual meeting that they have. And there will be cameras there. There will be news media there, and they'll be asking questions to Jerome Powell. Like, hey, what are you going to do now? You know, you had a bad jobs report the previous month. This initial jobless claims data today was really good. And you had a really good CPI print, 7 months of that. And now we have this hotter than expected wholesale inflation numbers. So I'd say the jury is still out. But what I would say is this is you can't argue the fact that if you're going to collect, let's round it up here, $30 billion worth of tariffs on a monthly basis, which would imply about a $30 billion annual run rate or 1% of GDP. Somebody's paying for that. I think nobody argued that forever, but what the news said is basically consumers are going to pay for all of that. Obviously, that's not true. And that's part of the reason why the stock market's taking this in stride because it's one of two things. It's either persistent consumer inflation, which meaning that prices for goods and services continue to increase. In other words, the rate of change continues to go up and to the right. Or is this, hey, this is a one time bump in prices due to this thing called tariffs. And now we're going back to normal, which is kind of what the end of this article is wrapping up with. This Bank of America economist is essentially showing their view that they don't expect this to be persistent. But if you read the middle of this article, there leaves a lot of questions about that. So that's the main takeaway here. This was fair and balanced in my view, which is why I'm giving Barron's a ton of credit. But I say the jury is still out, and the market is reacting to it in that way because interest rates have moved up a little bit, but nothing dramatic in any way, shape, or form. Um, and the indices are certainly down a little bit here this morning across the board. Dow, S&P, NASDAQ, all down. Bitcoin's down the most. Um, on the back of this news, but it's certainly not falling off a cliff like what was reported, say, February, or even early part of April, right around the Liberation Day moment that made news headlines around the world. I don't have a exact suggestion for the Fed other than this. I would just simply say that given all the information that has been received, it's certainly not as bad as what the Fed had thought at the beginning of this year, and certainly not as bad as what they had said in the April meeting that they had post Liberation Day. I'm glad that thankfully it hasn't caused major pain for investors or stock markets given their lack of uh, making a decision on rates, basically just sitting on the sidelines and watching all this stuff play out. We haven't had any major issues other than the news basically scaring everybody for 7 weeks there earlier in this year, which is why we continually go back to history in those moments in time. There's a lot of history that the Fed can point back to and say, yeah, we've had a lot of really good inflation prints, then boom, this weird thing happens here with one of the inflation prints. Well, most of the time, it hasn't led to persistent inflation. Uh, One of those times where it did, and the Fed got it way wrong, was during obviously the COVID situation where they thought it was very transitory due to shutdowns of supply chains, et cetera. They were wrong about that. So I think history is the best guide as opposed to just taking your P's and Q's from whoever the Fed head is at any moment in time. What I can say is that I don't expect much to change here regarding expectations for interest rate cuts, because if you're looking at the probability of interest rate cuts, even after this announcement, it hasn't moved that much. It was 100% certainty as we came into the morning before this inflation print, but now it's still in the 90% range of a 25 basis point cut. I think that 50 basis point rhetoric that was been thrown out there, I think there's just a lot of people saying, hey, I want interest rate cuts real bad. And obviously, I would take a 50 basis point cut as a stock investor. That's not going to be a bad thing, particularly when the job market's staying steady. I think you still get the 25 basis point cut in September. And I think that the odds of that certainly will change as we get into next month's data. As I mentioned, the Fed will have one more look at CPI and PPI inflation, as well as jobs data next month. And then they'll actually have an official meeting where they'll make an announcement regarding a rate decision. They might keep them steady, they might lower it. They're not talking about increasing it, which is certainly a good thing. So I still think you get your 25 basis point cut here in September. And I do believe that you'll find one more of those in the calendar year 2025. The question is whether or not we get a third rate cut. I think that the odds of that fell substantially from over 50% to less than 30%, given the news here we got this morning regarding wholesale inflation. So definitely going to be paying very close attention. And I think the rest of the world will be next week at Jackson Hole, Wyoming, when the Fed chairman speaks. Obviously, these are going to be questions that he is asked. I'm curious if he'll even address them or if he'll use his normal talking points or, we don't really make decisions on one piece of monthly data. That's historically what he's always said. He might have more to say about that this time. So we'll see. We're not hearing any news from the White House this morning regarding this wholesale inflation figure, but I'd have to imagine that that's definitely going to be a part of the afternoon news as we go about our day. Now, keep in mind, we're about to wrap up or officially wrapping up earnings season. Basically, you got one really big one on August 27th, which is Nvidia's earnings announcement. Obviously, that's a huge stock in the S&P. It's a big holding for our customers as well, and that's important. But other than that, there really isn't hardly any earnings news. So here's what I'm about to drop on the audience today. What you should expect when there isn't any news to talk about is the news is still going to do a really good job of bringing things to your attention to talk about. So what is it going to be? It's probably not going to be anything positive because here's what the news knows. Human beings that watch their show, they're also investors. Investors feel losses emotionally twice as much as they'll feel good about any amount of money that they might make in a period of time. That just simply means we're risk averse by nature. And if you're a news outlet and you're trying to drive revenue because you're for profit business, Well, you need your audience to be engaged. And the best way to do that is to placate to that fearful side of every human being. As I just described, we are more twice as engaged emotionally when we're more fearful of something. So expect that the news will run with this news of wholesale inflation being hotter than expected and all the potential problems that that might cause, or what's the Fed going to do given their dual mandate of maximum employment and price stability. This is the only thing that they're going to talk about because there's nothing else to get into. There's no other corporate earnings events. There's no official Fed meeting. None of that until you get to the middle of September. I expect history to kind of repeat itself given that backdrop. History says that August, late August, early September has very low volumes compared to other points in time in a calendar year. Humans traveling, going on vacations, getting one more trip in before school starts, tends to lead to market reactions not being so great, even if it was really good news. History says that that part of the calendar year just isn't all that great on average. Sometimes it is, but the majority of the time, on average, you shouldn't expect a lot out of the portfolio or the S&P or any of the indices. But the news having to put on some show every day has to talk about something. So expect that. And here's why we're here to do this show and why we've separated ourselves from a lot of our competitors in the wealth management space. The news already did this and continues to do this over and over again every single year. It's just a different news headline at that point in time that's probably happened many, many other times in the course of history. And I'll give you a perfect example. Earlier this year, that sell off, 7 week sell off, mid February through about the middle of April, that was the fifth fastest drop in S&P 500 history since 1950. It means there were four other times where it was worse. And obviously, the news did a really good job of running with that too, just like I think they're going to do a really good job of running with this hotter than expected PPI news and just squeezing all the juice they can out of that over the next 4 or 5 weeks until we actually get to really important news regarding Fed decisions in September. So earlier this year, the news freaking everybody out regarding tariffs and skies falling and it's going to be the worst thing ever for the U.S. economy and we're going to be a third world country now. I mean, that was literally what was talked about during that period of time. You're going to hear similar things over the next 4 or 5 weeks. So here's what we did. We said, hey, the market's had the fifth fastest drop in S&P 500 history since 1950. Well, what were the other four times like? And let's compare the two. The other four times, first of all, had very specific reasons why the market lost so much. One was Black Monday in 1987, a lot of currency problems globally. That was one of the single worst days in stock market history. Market being down nearly 22% in one day. That's why they call it Black Monday, 1987. By the way, for the year, S&P was positive by 2%, even though they had that one major drop day. The other three times where it was worse happened twice in 2008. We all know why that happened. We had banks that have been around 150 plus years went to zero due to their greed. And that was a really hard data point that caused market sell offs. And the last one that was worse than what we just went through here earlier this year was COVID, March of 2020. We all know why the market sold off so much so quickly. When you shut down the whole global economy, you can expect that to happen. This time, what do we get? We have this potential impact of tariffs causing inflation, causing joblessness. I mean, if this is what the news was saying, is might happen. And a lot of really smart people, way smarter than me, went to way better schools than I did. PhD economists were talking about the major impact that this administration is going to have negatively on the economy. And just none of that's played out until today. We got some spike in wholesale inflation. So I think the jury is still out. But that was the news that caused a sell off over that 7 week period of time. But here's what we said, that was a lot of ifs and maybes and mights coming from economists at that time. They had no idea. They said it with a lot of certainty, like they knew for sure, just like Jerome Powell said, I know that this is coming, this is going to happen. So I'm very curious to what they have to say, given everything that they've said for 7 months. Now they have some leg to stand on. So I'll see how far they run with that, as well as the news. But getting back to the sell off that happened and what we experienced earlier this year and what we did for our customers is we bought the market, but not just for a contrarian reason to buy the dip. We said of the four instances where it was worse than 2025 market sell off, well, 4 out of 4 times the market was positive 12 months later. So, in other words, there was a 100% win ratio. For the long-term growth investor, that should get you excited to want to go ahead and potentially buy the dip. But the other question you have to ask yourself based on that historical data is what was the reward? Well, the average return on all four of those instances where the market lost more faster than what we saw in 2025, the average return was 34%. So 100% win ratio 12 months out with an average return of 34%. Again, these are averages, could be higher, could be lower. And again, past performance is no guarantee of any future result. Investing definitely always involves risk. But that's a risk that I was willing to take for customers. 100% win ratio under those four similar instances with an average return north of 30%. The market just doesn't simply give you 30% returns annually. That's a very attractive number. And to me, as a long term growth investor, I don't see a lot of downside to that unless this is the one time in human history where markets continue to fall over the next 12 months. You have to be willing to take that risk, right? If you're going to buy the market under those historical circumstances, you might be walking into the one time in human history where the trend gets bucked, but I would be willing to take that risk uh, time and time again. And it's certainly paid off big time for our customers. With our customers, as of this morning, are averaging just shy of 30% year to date returns net of our fee. Now, that's across all accounts on average. The market's up nine. Okay. We didn't get lucky. We didn't just do it because it was the contrarian thing to do. We pointed to tangible historical data based on other human beings' reactions to similar data, and we made some tactical decisions. That's what I call value. And the value is in the process. And the process can be repeated over and over and over again, regardless of who the next Fed chairperson is going to be, regardless of who the next president of the United States is going to be. And that's what makes me proud. That's what gets us up and excited to do our job every single day for customers, knowing that we have value to bring to the table through this process of making portfolio decisions. It can be repeated. That is what gets me excited. That's what makes me proud about what we've been able to accomplish here at Shepherd Wealth Management. It's not necessarily the bottom line result. Yes, I am pumped for my customers. I'm so happy for them. It's great. But what they're really looking for is this a one-time shot flash in the pan? Or can I rely on these people here at Shepherd Wealth Management to navigate all the different things? So if you think seriously, like Ezra and I have been doing this podcast for 4.5 years. If we were to sit here and rattle off all the news headlines for 4.5 years with two wars that went off, presidential, all this stuff, any one of those things in a vacuum could have made anybody's portfolio's performance be very similar to the S&P 500 over that 4.5 years or worse, which is where most people fall. Is they're worse off than the S&P. That's just the simple truth of the matter. Most investors underperform the stock market on average. And maybe that's your goal, is to not outperform the S&P. That's fine. A lot of people are trying to do better than the market, and most of you are not. And that's not my opinion. You can go to Google, you can search white papers at Vanguard and any other place. And by the way, when we drop names, Vanguard or any individual stock, I don't get any kickbacks for any of those companies when we bring them up here. It's just for all the compliance hawks out there that might be listening. That's not my opinion. Everybody and their brother on Wall Street, for decades has said, yeah, most investors significantly underperform the S&P 500. There's all kinds of data about that. Not my opinion. So what do you need? You can do one of two things. You can do the Vanguard approach, which made Vanguard buy the index. Leave it alone. Problem with that is you're going to have to ride the whole roller coaster of that index up and down forever. And I don't think a lot of people find success in that because they, again, don't have any perspective. They don't have any control over their emotions or their temperament. Which unfortunately, if they follow that Vanguard approach and they get too emotional, well, they can easily just log in and start selling stuff with no context to it other than it doesn't feel good to watch the red on my screen. It doesn't feel good to see my personal wealth declining right in front of my eyes. What you need is a process or a person with one. And that's what we're here at Shepherd Wealth Management to do. I'd love to work with you. If this is interesting to you, you want to learn more about it, please check us out, shepherdwm.com, brand new website. All kinds of information about the firm, myself, my business partner, the locations that we have, and all the ways to get a hold of us. And if you're curious as to how we've been able to deliver through all these 4.5 years of really most of the time just brutal market headlines, and we got this fantastic result. There's a reason for that. It just didn't happen out of nowhere. We didn't get lucky for 4.5 straight years. There was a process involved with that, and that is what is so valuable for our customers, and why I want to do this podcast about every 2 weeks for our audience, is to help you understand it's not the intelligence of yourself or the portfolio manager. Matter of fact, Warren Buffett has a famous quote about that. He doesn't want somebody with 180 IQ. Somebody with 180 IQ is not going to do any better than somebody with like 105 IQ when it comes to investing if you have no control of your emotions. Matter of fact, the people that have the highest IQ tend to be some of the worst investors that I've ever seen because they overanalyze everything, right? Makes it very difficult for them to pull the trigger because they have to look under every little nook and cranny of a balance sheet and income statement. And before you know it, you just missed market growth. And now you're questioning, well, should I invest now? The market's already up 10% here year to date. Well, there's more history to come on that, right? Got to have the right perspective instead of a gut feeling. Here's what history has to say. First half of the year was positive, somewhere between 5 and 10%. It was actually about 9%. Under that historical precedent, when the first 6 months of the S&P is positive, somewhere between 5 and 10 percent return, the back half of the year is positive about 89% of the time. And the average return is 6.1%. That is some pretty good context coming into the back half of the year, even though we just got some really hot wholesale inflation figures. So you can't just turn your brain off to the news that we got here today. It's certainly something that you're going to want to pay attention to. Like the trend, as I'm talking about, the bigger trend of inflation is the important thing here. But if you understand the history of the market and how other human beings have behaved under very similar circumstances, you don't necessarily have to freak out based on today's higher than expected wholesale inflation print. I just gave you a lot of reasons why you don't need to freak out. But what you do need is a process, because the news is going to continue to deliver content every single day throughout the remainder of this month, this quarter, and this year. Some of it's going to scare the hell out of you. Some of it is actually going to be like, holy crap, I can't believe that the market's up 10% given all this news that we thought was going to be so terrible. This is the reason why $7 trillion is still sitting in cash. They missed out on a free 9%. I shouldn't say free because you do have to take risk even if you're buying the S&P 500 index or any index for that matter. So it's not a free 9%. You did have to take risk and participate through all of those news headlines for the first 7 months of the year to attain that. But based on the historical data that we're talking about here, the back half of the 6 months should be pretty good unless something really changes. And that's why we have to continue to be attentive to the news that is dropped, but have the bigger picture perspective in mind. And that will lead to more consistent success, I believe, for your own personal net worth. And that's difficult for you. That's what we're here for. We'd love to have the opportunity to sound, help you understand this in more detail, and ultimately love to work with you. So, with that, Ez, I know we covered a lot of ground here regarding inflation. We got some jobs information here. We got some historical stuff. I think I need to wrap up with expectations of what we're planning to do here, given all that historical data. But before I get to that, anything else that we wanted to cover, or any questions while we were rattling this particular podcast out?
Nothing came in. Smooth and easy episode. I was glad to hear Barron's in a positive light.
Yeah,
So that
yeah.
was nice.
Good
Way to
job,
go.
Barron.
Keep it up, Barron's.
Yeah.
Who did you
Um,
say the author of that article was?
Megan, I lost her last name. I
Yeah,
had to pull
well,
it back up.
it's in the podcast. We just don't remember now. Bring her back. Bring them back, Barron's, for
I
sure.
like it. I like it.
We need more
But as
reporting.
far as what we're going to do, right? So bullish about the back half of the year. Earnings were great. Awesome earnings. Nvidia is a big one coming up here. Expect earnings next quarter to be just as good. There's plenty of cover for CEOs in every industry to pull their guidance. They didn't. So I'm very excited to see that. But what we're going to do is rebalance. I've been looking for an opportunity to rebalance. I think finally we have an opportunity to rebalance. So likely tomorrow on Friday, August 15th, what we've been telling clients is we need to rebalance. And I think that tomorrow is going to be the day. So here's what we're going to do. We made a ton of money in technology. That sector, we overweighted it big time. It's what got whacked the hardest during that 7 week sell off. We bought very specific names within the tech space and overweighted those. And that's certainly what's led to the types of numbers that our clients are enjoying. But I've always said that if you do not rebalance your portfolio, the market will rebalance it for you. They're just going to do it in an unkind way. So eventually, you got to ring the register. And we're doing this in our IRA accounts. We're not doing this in taxable accounts for the most part, for most customers, because most don't want to trigger a taxable event yet. We'll get to those specific situations in our October quarterly reviews as we're doing some tax preparing at the end of this year. So in IRA accounts exclusively, for the most part, we're going to take profits away from some of those big tech names that we've made a lot of money in. We're still going to own those names. We'll still be overweight most of those names relative to the S&P 500 weightings for some of those stocks. So we'll still be overweight tech for sure. We'll still be overweight consumer discretionary names for sure. But we're going to take profits away from that. And what are we going to do? We're going to add some diversification. We're actually going to get a little bit fearful while others, I believe, will start to get greedy. So that $7 trillion that I'm seeing in money markets here today, that's missed a 9% ride in the S&P 500. Pullbacks in the market should be shallow. And history would support that. When you see that much cash sitting on the sidelines, specifically when they've missed a 9% run in the S&P 500, that money is human money. And humans, well, we have a thing called fear of missing out. Specifically, when our friends and neighbors and other family members that we might not think are as good at investors as we are that are enjoying 9+% return so far at the S&P 500. That fear of missing out factor is going to drive investors to pick up some names that they missed out on any pullback over the next 5 weeks. That, in my view, that's what history would support. That much cash that's missed a 9% rally in the market will find a home in stocks on pullbacks. So I do expect pullbacks over the next few weeks because that's what history has to say. But I do expect a lot of those pullbacks to be very shallow. So we have a really nice opportunity to rebalance here for our customers. History's on our side here and giving us this opportunity, but also likely going to get bought on any market sell off given the extreme amount of cash that's just sitting around doing nothing. So we're going to take profits away from tech and consumer discretionary names while still being overweight them because we overweighted them in such a way earlier this year that would allow for us to take profits while still being overweight. And we're going to add some diversification. We're going to add some industrial names. We have very little exposure to no exposure in client accounts, which, by the way, that sector's done much better than the S&P. Industrials being up double digits, which again is better than the market so far here year to date. But I don't think that we've missed out on any of that because manufacturing production has yet to spike. Although I can see how that can play out for that sector over the next 18 months, given the tax bill that was passed. Obviously, lower tax is a good thing for manufacturers. They can now expense retroactively any plans or investments that they're making in R&D and plants, facilities, etc. All big deals. I do expect rates to come down, and the fewer rate cuts they do in 2025, the more cuts are likely going to come in 2026, especially as Fed Chair Powell steps down. More importantly for that sector, more importantly than all of that, and that's a really good tailwind for a manufacturer, an industrial stock, or the industrial sector. More important than any of that is the deregulation part of the bill that was passed earlier this year. That is for sure a very powerful thing that doesn't get talked about enough in the news outlets. And I expect the manufacturing sector to have tremendous tailwinds behind it, giving all of that information I just dropped on you. And the more and more clarity that we get with other countries regarding trade is certainly going to be a bullish thing for that sector. And obviously, the elephant in the room being China with another 90 days of negotiations based on what we know right now. So, major tailwinds for manufacturers going into the back half of this year and into next year, in our view. And we want to be participants in that space. We will definitely pick up 2 or 3 big, large industrial type of names over the next several weeks. So the plan is to sell tomorrow in IRAs, raise some cash, have that cash ready to deploy into manufacturing names over what we think will be a 4 or 5 week seasonal market sort of, I won't call it a sell off, but some consolidation. And I think it's a very small consolidation given all that $7 trillion just sitting around doing nothing. The last thing that we're going to do, history would also support this, is historically, as interest rates come down, being cut by the Federal Reserve, small caps tend to, in a short to intermediate period of time, outperform most sectors, if not all sectors in the S&P. And we actually saw that happen as the probabilities of interest rate cuts went to 100% on the back of Tuesday's CPI print. Um, Small caps were up 5% in 2 days. Now, they're giving some of that back here today, given the hotter than expected wholesale inflation number. Small caps are down 2%. So they're certainly giving back some of that gain. But the market is using that historical precedent of rate cuts being a really good thing for smaller cap types of names. And it makes perfect sense because those names in that index are all, for the most part, doing business 100% right here in the United States. So lower taxes is certainly a good thing, but lower interest rates is a major driver of their earnings because they typically need to finance their business operations on an 18 to 24-month basis. So lower interest rates is just boom, immediate impact for small cap names. And in addition to that, if you're going to buy the index like we're planning to do at some point over the next 4 or 5 weeks, anticipating some sell off, right? Glad we waited. Even though it would have been great to pick up 5% in small caps over the last couple of days, you're giving back 2% today. So we haven't really missed a lot of this in our view. But I do want to participate in that space given the historical outperformance that you typically would get in a rate cutting cycle environment for that specific index. And half of that index, by the way, is broken down into two sectors that we really want to participate in, given all the information I just dropped on you. Half of the small cap index, 35% of it is manufacturers, just smaller ones. Again, I want to be in that space for all the reasons I just described. And then another 15% of that index is financial. So think of smaller banking institutions, financial institutions. Lower interest rates is usually a good thing because it drives loan demand. That's the primary way that financial institutions like banks make money. And lower interest rates means that they don't need to pay you on your deposits. They're not paying you anyway, but that's giving them even more reason not to pay you on any deposits. So certainly historically a good thing for the financial sector as well. So those are two moves, rebalancing moves based on historical data, even on the face of a hotter than expected wholesale inflation print today, which is something I will be paying attention to. It is grabbing my attention, just like it is for Barron's and other news media outlets. But you got to keep the big picture in mind. And the big picture backdrop is very bullish in our view. And until anything changes with that bullish thesis, which would certainly, could be derailed if you saw major jobless claims spiking or consumer price index sustaining higher than expected inflation prints month over month, that would be a problem. But you can't make that conclusion just yet, especially based off of one piece of Wednesday wholesale inflation data, given that 7 months of awesome data, including this Tuesday's consumer price index. So please, please, please do not get fallen into this trap over the next 4 or 5 weeks of when there's no news. The news is certainly going to hang on to this because it is going to be a talking point. It is going to be brought up next week at the Fed Jackson Hole Summit. It's certainly going to be talked about between now and the next Fed meeting, which is mid-September. So keep the bigger picture perspective in mind. Use history as a lens to put the risk and reward perspective clearly in front of you. And I think that you'll find more consistent success. So really appreciate being able to deliver this content on a bi-weekly basis. We'll be back again in a couple weeks. Look forward to your feedback. You can leave your comments and questions in the comment section below, right on YouTube. And we'll catch you guys right at the end of the month. Hope you have a great rest of your Wednesday or Thursday. And we'll see you again in a couple weeks. Take care.